Business, wealth, and strategy, where smart entrepreneurs build lasting wealth. That unfolded this past week across the US, the UK, and the EU. It's been a week of big moves, markets reacting, inflation stirring, and central banks adjusting strategies. If you're trying to make sense of what's happening and what it means for your business or your investments, you're in the right place. But let's get started with what's happening in the US. As we know, whatever happens in the US flows out to other countries. So the United States economy has had a turbulent week, and the waves are being felt globally. Inflation expectations surged. Following the rollout of new tariffs, inflation expectations jumped significantly. It's one of the reasons Trump paused the tariff implementation for 90 days. Economists now anticipate inflation will stay above Federal Reserve's 2% target, at least until 2027. This is key because inflation expectations influence everything from mortgage rates to long-term investment strategy. With prices likely to remain higher, consumer purchasing power may weaken further, which can ripple into slower economic growth. The Fed is walking a tightrope. Federal Reserve Chair made headlines this week, signaling concerns that tariffs may drive inflation and unemployment in the wrong direction. This adds pressure to already difficult monetary policy decisions. Rate cuts, once anticipated to stimulate the economy, may be delayed. The market now expects just 2 rate reductions this year, far fewer than previously hoped. And investor sentiment hits a 30-year low. Investor confidence nosedived. A recent Bank of America fund manager survey shows 80% of respondents now view the trade war as the biggest tail risk in the market, higher than during the 2008 financial crisis. 9 out of 10 expect global stagflation, a toxic mix of high inflation and low growth. As a result, the S&P has dropped 12% from its February peak. For investors, this signals caution, portfolio adjustment, and possibly a shift to more defensive sectors or income strategies. I will say that price cost averaging, which is one of the things that I advocate, especially using monthly income dividends, is perfect when we have this kind of turmoil in the market. Consumer prices and retail warnings have been in the headlines. Retail giants like Walmart and Target have stated significant price increases due to rising import costs. This means households may feel the squeeze as the cost of everyday goods increases again. If we're heading into a cycle where wages lag behind inflation, consumer behavior will shift. Less discretionary spending, more focus on essential goods, and a tightening of household budgets. Tourism took a hit, and that's something a bit unexpected. The tourism sector is under pressure. The US is projected to lose billions in tourist spending as geopolitical tensions and economic uncertainty weighs on travel plans. This matters because tourism supports local economies, especially service-based jobs in hospitality, food, and entertainment. As someone who watches trends, it's clear we're seeing the early signs of a correction. Not necessarily a collapse, but a cooling off. If you're building wealth, this is a time to double down on education, manage risk, and stay calm in the storm. This isn't the time for panic. It's time for strategy. Now let's cross the Atlantic to the UK, where the mood is also shifting under the weight of global uncertainty. After a period of relative stability, UK inflation is expected to rise again, forecasted to hit 4% by the summer. The cause? Climbing household bills and the knock-on effect from rising import costs globally. For UK households already feeling the pressure, this brings back memories of the cost of living crisis a few years ago. The Treasury has halved its 2025 growth outlook from 2% to just 1%. And that's being adjusted. It looks like it's going to go down even more. Higher debt interest payments and global headwinds, especially those stemming from US tariffs, are forcing a rethink on spending priorities. But here's a bright spot. Retail footfall rose 3% across high streets and shopping centres last week. It may be tied to Easter promotions, but it shows consumers are still engaging, at least for now. In a bid to close a 14 billion funding gap, the government has proposed welfare cuts and tighter anti-tax avoidance measures. Critics argue these cuts would deepen inequality and raise poverty levels, especially if inflation continues to rise. For investors and business owners, this creates two key implications: reduced consumer spending and possible social unrest if policies are not carefully managed. On the geopolitical front, the UK is ramping up defence spending by 2.2 billion. In uncertain times, governments often shift spending to security and infrastructure, and this signals that the UK is preparing for longer-term instability. The UK is feeling the ripple effects of a global strategic war, where trade, inflation, policy choices are all connected. If you're building a business in this climate, it's important to monitor consumer trends closely. Those that adapt quickly, especially in how they price, market, and deliver value, will come out ahead. Finally, let's have a look at what's happening in the European Union, where again, policymakers are walking their own tightrope. The European Central Bank has cut interest rates for the seventh time over the past year, trying to fight stagnation and encourage borrowing. But unlike previous cycles, this move is less about growth and more about damage control. Growth forecasts are slashed to 0.9%. That's less than the 1% growth forecasted for the whole of the EU in 2025. The biggest cause? Slowing trade, tariff pressure from the US, and weakening consumer confidence. This is a critical point where three major regions, US, UK, and EU, are all facing slowing growth. Global investment strategies need to shift from aggressive growth to capital preservation. US tariffs are hitting Europe hard, especially manufacturing and agriculture. Germany, Italy, and France have already seen export orders drop, and small economies like Portugal and Greece are feeling the secondary effects. The DAX and the FTSE indices have seen significant drops, mirroring investor sentiment globally. Volatility indexes are up, and money is flowing into safer assets like bonds, gold, and dividend-producing stocks. On a hopeful note, Italian Prime Minister Giorgia Meloni has offered to mediate between the EU and the US on tariff dispute. If successful, this could ease tensions and restore trade flow, but With all diplomacy, only time will tell. Europe is under pressure, but it's also in a strategic position. It can either become a buffer zone between the US and China or emerge with a stronger internal economy. For us as entrepreneurs and investors, the lesson is to watch where capital is flowing and follow it. So, what does this mean for you? We're in a moment of transformation. Old strategies may not work the way they did even a year ago. For smart entrepreneurs and investors, this is a time to review your portfolio, assess your business model, and make sure you're building resilience into everything you do. So let's recap. In the US, inflation and policy tensions are clouding the outlook. In the UK, household budgets and government spending are under strain. And in the EU, central banks are taking action, but the road ahead is slow. If you've enjoyed today's podcast, don't forget to subscribe and leave a review. You can also check out the latest blog at karennewton.co.uk/blog, where I'll share a breakdown of today's insights, plus some tips for adjusting your investment strategy in light of these changes. Until next time, stay smart, stay strategic, and keep building your wealth.